ACCA, Developing Professional Accountants.
Again, with advanced variances, what I want to do here is to look at specific sales variances and idle time variances. But I must emphasize that what we are looking at is based on the original variance analysis discussion we've already had. If you're unhappy with that, please make sure that you're fully happy with it before you move on to the more advanced variances. We now want to look at sales mix and quantity. This is where we sub-analyse the volume variance into a mix part and a quantity part. It only really makes sense to do this if we have, of course, more than one product, a mix, and that mix is in some way linked. Maybe they're complementary products or substitute products, but in some way there is a link between one product and the other. Okay, when we look at these calculations, they're very straightforward. Nothing like as difficult to say mix and yield. If we just look at the information in the question here, we've given budgeted sales and actual sales. We're also given the standard contribution. Now we have to remember that the volume variance is simply this: actual sales minus budgeted sales multiplied by, well, in this case, the standard contribution margin. Okay? So we could easily calculate that. What we want to do is to take this particular variance and break it down. We want to break it down to reflect the fact that there is both mix and quantity to consider. Now, where do we get the standard or expected mix from? Well, it's not difficult. We already have it in front of us. If we totaled the sales, we have 2,000. And therefore, if we were to look at the budgeted sales in terms of mix, couldn't we say that 40% of them relate to A and 60% of them relate to B? So all we have to do is to develop a pro forma that works for this. Now, if you think about it, our original pro forma was actual sales minus budgeted sales. That was the sales volume. All we're going to do is to introduce in the middle actual sales at the standard mix. So not difficult at all. By doing so, we get the sales mix variance by comparing the actual sales at the actual mix against the actual sales at the standard mix. And then once we've got that, we can get the sales quantity variance. So very straightforward indeed. Again, you may wish to use a little working like this. You don't have to draw the boxes up. I don't think it's that fantastic, but it maybe just helps a little bit. So if we were looking at actual sales at the standard contribution margin, let's pick up the numbers from what we've seen before. So, actual sales for A were 500, and the standard contribution was 5, and the actual sales for B was 1,500, and the standard contribution was 8. So we end up with 2,500, and we end up with 12,000. A total of 14,500. Then we can look at the actual sales at the standard mix. Now, how many actual sales were there? Well, if you think about it, we had 2,000 actual sales, just summing the two numbers above, 500 and 1,500. We expected 40%, or 0.4 of them, to relate to A. And that had a contribution of 5. And we expected 60% to relate to B, and that had a contribution of 8. So, 40% of 2,000 comes to 800. 800 multiplied by 5 is 4,000. 60% of 2,000 is 1,200, multiplied by 8 comes to 9,600. A total here of 13,600. Finally, we have the budgeted sales at the standard mix. Well, the slightly curious thing about this question is that we end up with exactly the same values as we had for the actual sales at standard mix. Can you tell me the reason why? Well, in simple terms, the volume in total terms of 2,000 is the same for both budget and actual. That means that when we come to look at the mix variance, we see top minus bottom, we've got 900 favourable. And that simply means that although we've sold the same number of units, we have sold more of the higher contributing product and less of the lower contributing product. If we were to look at the quantity variance, there is a nil variance. And that's because the overall quantity of units is the same for both budget and actual at 2,000. So when we look at sales mix and sales quantity, this should not be a difficult area. This is something that we should easily be able to deal with. A further analysis that we may do with regard to sales variances relates to market size and market share. The argument goes something like this. We can take our volume variance, and instead of just looking at the volume variance, we can say, well, some of that change is due to the market growing or shrinking. And you could argue that the market size is beyond our control. So possibly we could say it's a planning variance. Whereas the market share is whether or not we have managed to retain our part of the market. Now, from that perspective, that is maybe more controllable and maybe the thing that we should focus on. So we would describe that as an operational variance within the control of management. Now, if that's the case, all we want to do is this sort of working. Remember, the sales volume variance is actual sales at the standard contribution margin compared to the budgeted sales at the standard contribution margin. That's not difficult. All we have to do here is to have revised sales based on the actual market size. By doing so, we can easily calculate these two variances. A further area of advanced variances is when we look at idle time variances. Now, what is idle time? Well, people come up with a whole host of different definitions, but to me, the simple definition is this. It is the difference between hours worked and hours paid. Now, typically, this is due to machine breakdown or something of that nature. We don't care. All we want to do is to focus on the distinction between hours paid and hours worked, and we will always be fine. To deal with this, let's look at a simple example. Carragher. We have our labour standards up top, and then we have a distinction between hours paid and hours worked. Now, if that's the case, what I want to do is to take the basic labour variance pro forma that we've already used and to slightly adjust it. This will not be difficult. So what we have here is the basic pro forma that we know and love. Actual hours, actual rate, actual hours standard rate, and standard hours standard rate. But what we've done is we've introduced a little bit more just to make it absolutely clear. We've made a distinction between hours worked and hours paid. If you wish, all we have done is taken the efficiency variance and separated it into two variances, a more refined efficiency variance and a variance due to idle time. So let's see how this works. Starting from the bottom, we have our labour cost of 32,000. And then we might as well pick these up at the same time. We know the rate per hour is 6, and the hours paid and worked are 5,5 and 4,2. So, actual hours, actual rate, 32,000. Actual hours paid, 5,500, multiplied by the standard rate of 6. That will come to something like 33,000. Actual hours worked, 4,200 multiplied by 6. That will come to 25,200. If we now look at the standard hours, remember, standard hours relate to the actual output. We said that there were 3 standard hours, and the actual output was 1,300. We multiply by the standard rate of 6, and that gives us 23,400. So, the efficiency variance, top minus bottom, 1,800 adverse. Adverse because it's negative. Excess idle time variance, top minus bottom, 7,800 adverse. And the rate variance, 1,000 favourable. Now, if we're calculating idle time this way, it must be adverse. It is highly unlikely that people are going to work more hours than they are paid. But now what we have to do is to look at a situation where we may expect idle time to occur. Now what I want to do is to talk about the idea of excess idle time, or budgeted idle time. You see, in some operations, it's possible that we always expect idle time to occur. The classic example is if you have seasonal variations in maybe your production process. And in spite of the fact that you don't have sufficient work, you may wish to keep certain employees fully employed because you need them at other times of the year. Now, if this is the case, we have to be a little bit more careful about how we play with things. So let's look at a simple example. A company budgets to pay 10,000 hours of labour during the year. Due to seasonal and other factors, it is expected, budgeted, to stand idle 20% of the time. So budgeted hours worked are simply going to be 10,000 multiplied by 0.8, 8,000 hours. The problem we have is this: because we budget to lose these 2,000 hours, we've got to make sure that we recoup all of the costs of labour over those hours that are worked. So if we move on, we're now told that the company pays £5 per hour. Okay, so I just want to take that number for a moment. We'll come back to the formula in a second and say, well, okay, we pay £5 an hour, so the total cost of labour is 50,000. And if we only expect to work 8,000 hours, we've got to attach that total cost to the 8,000 hours worked. Oh, so when it comes to looking at the standard rate per hour, what we need to do is to charge, what, $6.25 in order to recoup 50,000 over the reduced number of hours. In simple terms, what we're saying is that if we're going to say we lose 20% of our time, we will have to divide through by 1 minus that amount to make sure that we recoup the total amount over the reduced number of hours. So, what we have to remember is to do this key working. The standard rate per hour worked is going to be the standard rate paid over 1 minus the idle time percentage. The standard rate paid, we said, was £5. 1 minus 0.2 is 0.8, and hopefully that comes to 6.25, the standard rate per hour worked. So, we're going to make a distinction between the rate per hour worked and the rate per hour paid. Now let's go back and think through our pro forma. What I do is this. I simply take the pro forma that we had before and say everything above the line is going to be worked. Worked, 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 worked. And everything below the line is going to be paid. Paid, 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 paid. Very straightforward indeed. Remember, I don't want you to think, I just want you to be able to do these variances. So let's go back to the example we had before. We've got exactly the same labour standards. We've got exactly the same units and hours. The only thing now we have is we've got budgeted idle time of 20%. What's the first thing we have to do? Well, the first thing I want you to do is to get the standard rate per hour worked. So the standard rate per hour worked is going to equal £6, the standard rate paid, multiplied by 1 over 1 minus the idle time percentage, 1 over 0.8. And we end up with a standard rate per hour worked of £7.50. Now we can then bash through the variances. Actual hours paid, actual rate paid has not changed, 32,000. Actual hours paid, standard rate paid, I don't think has changed either. We had 5,500 hours paid, and the standard rate paid was 33,000. Actual hours worked, 4,200. But because we budgeted idle time, we now have to charge the higher standard rate per hour worked, 7.5. And that gives us 31,500. And standard hours worked, 3 hours per unit for 1,300 units, multiplied by 7.5. And it comes to 29,250. So, top minus bottom, we end up with an efficiency variance of 2,250. Adverse because it's negative. Top minus bottom, the idle time variance is 1,500. Still adverse, but a lot smaller than we had before. And the rate variance, top minus bottom, 1,000. Favourable, it has not changed. In summary, when we look at the advanced variances, I want you to concentrate on doing the basics well. If you do that, you will be able to get the numbers out. Remember, my emphasis here has been on your ability to compute things. My view is if you can get the numbers out without thinking that much, then you can concentrate your brain power in trying to understand what the examiner is getting at and what these numbers are telling you.